Welcome to Restaurant Business Masterclass episode 6, and today's topic is the economics of restaurants, unit fundamentals of profit and growth. Friends, a successful restaurant is built on numbers as much as on flavors. Profitability depends on understanding unit economics with precision and with extreme discipline. That's going to be critically important for every restaurant. The restaurant industry excites entrepreneurs with creativity and opportunity, and yet beneath the excitement lies a discipline of numbers, margins, and unit economics. A profitable restaurant is not built on taste, it is built on financial clarity, operational efficiency, and sustainable cost management. We need to really absorb this well if you want to become successful in the restaurant business. Unit economics defines how much money a single restaurant outlet earns, spends, and retains after covering all expenses. Without this clarity, expansion becomes impossible. Friends, every restaurant operates on three financial pillars: revenue, cost of goods sold, and operating expenses. And together, they shape profitability and long-term sustainability. Revenue comes from multiple sources: dine-in sales, delivery sales, catering, events, and even merchandise, which contributes to the total income. Now, each stream requires strategy and focus. Cost of goods sold refers to the raw material used in preparing dishes. Food cost is one of the largest expenses and must be tightly controlled without compromising on the quality. Friends, an ideal food cost, depending on the brand and the cuisine and the type of concept that you are operating, an ideal food cost percentage typically ranges between 20 to 30% of revenue. When food costs rise beyond this, the margins collapse quickly. Negotiating with suppliers, sourcing locally, and portion control all help in managing food costs effectively. Standardized recipes also maintain consistency and protect margins. A brand like Santé Spa Cuisine can have margins, food costs go up as high as 35% also. Operating expenses form the next layer: rent, staff salaries, utilities, and licenses create fixed commitments every month. Now, these must be monitored constantly. High rentals destroy profitability for many restaurants. Choosing the right location with balanced rent to revenue ratio is one of the most important financial decisions. Friends, labor costs follow closely behind rent. Wages for chefs, servers, cleaners, and managers represent both an expense and an investment in your customers' experiences. Friends, utilities such as electricity, water, and gas impact costs significantly, especially in high footfall outlets. Smart energy management lowers overheads and improves sustainability of the business. Marketing, packaging, technology, and delivery commissions add further expenses. Many restaurateurs underestimate these hidden costs until they erode profits. Break-even analysis becomes very essential. Break-even refers to the sales volume at which revenue covers all fixed and variable costs. Beyond this point, profits begin to accumulate. Friends, restaurants must calculate daily sales targets based on break-even. If the outlet requires 50,000 rupees per day to break even, every strategy must aim to meet or exceed this minimum break-even level. Friends, contribution margin analysis strengthens this understanding. Each dish contributes a different margin. Dishes with higher contribution margins deserve promotion, visibility, and upselling. Inventory management plays a very critical role. Overstocking leads to waste, while understocking results in lost sales. Both affect the profitability directly. Now, technology assists in tracking consumption patterns, reducing pilferage, and ensuring just-in-time inventory replenishment. Debt and investment structures also influence financial health. Loans increase pressure with interest obligations, while equity investors expect returns through growth. Restaurants must maintain strong cash flow. Even profitable businesses collapse without enough working capital to cover salaries, vendor payments, and daily everyday operations. Seasonality impacts revenue. Festivals, weekends, and holidays will boost sales, while lean periods create challenges. Smart financial planning balances the highs and lows of the restaurant business. Menu pricing strategy integrates with economics. Prices must cover food cost, overheads, and target margins while remaining acceptable to all your customers. Dynamic pricing can also be applied. Lunch menus, weekday offers, and festive specials will help you to optimize revenue across different customer segments. Franchise models depend heavily on proven unit economics. Investors and partners replicate concepts only when per outlet profitability is stable and measurable. Scalability depends on efficiency. One profitable unit is victory. Replicating that profitability across 10 units requires discipline, systems, and financial transparency. Restaurants must also focus on average revenue per customer, increasing spend per table by upselling beverages, sides, or desserts, which improves overall margins significantly. Delivery-driven restaurants operate with different economics. Commissions from aggregator platforms reduce margins, making efficiency more critical. Cloud kitchens benefit from lower rentals but face heavy dependence on marketing and delivery cost. Their success relies on volume and brand visibility. Taxes and compliances add another layer. Goods and services tax, liquor licenses, and municipal fees must be budgeted carefully to avoid financial strain. Regular financial audits protect restaurants from leakage, friends. Cash handling, vendor relationships, and staff incentives all need transparency. Technology-driven POS systems integrate billing, inventory, and reporting, creating data-driven insights that support better decision-making. Investor interest increases when unit economics are strong. Investors focus on revenue per outlet profit margins and scalability across geographies. Restaurants that manage costs, optimize menus, and maintain strong cash flows attract higher valuations and funding opportunities. Financial resilience builds long-term success. Restaurants must prepare for unexpected challenges such as sudden rent hikes, raw material shortages, or policy changes. The most successful restaurateurs are those who blend creativity with financial intelligence. Flavor attracts customers, numbers sustain the business. Sponsors deserve recognition for helping me to create such content, and that's why I would like to thank my sponsors, Sante Spa Cuisine, which proves that profitability and wellness can exist together, offering food that is sustainable and commercially successful. Bod Active Gymwear demonstrates that consistent performance combined with style creates brands that scale across categories. Turning Red Media Studios shows that monetization is possible when creativity is supported with analytics and smart distribution. SDG 6 Technologies highlights that sustainability also requires strong economics with modular water solutions that balance cost and efficiency. Friends, let me share today's 4 key takeaways from today's episode. My first takeaway is unit economics defines long-term survival by clarifying revenues, cost, and margins. My second point is food cost, rent, and staff salaries represent the biggest financial levers in the restaurant business. My third point is break-even analysis, contribution margins, and cash flow discipline sustain operation. And my fourth point is scalable restaurants combine creativity with financial intelligence, ensuring each outlet remains profitable. Friends, I'm a strategic growth investor. I add value by combining money, technology, deep operational knowledge, and influential networks to accelerate business. If your business is ready for expansion, message me today and let us explore growth opportunities together. Before we conclude, friends, I would like to thank you for watching Restaurant Business Masterclass. Please like this video, share your comments, and subscribe for more insights. Mention the financial aspects of the restaurant business that you would like me to elaborate further in my upcoming episodes. Friends, your feedback will guide my future content. Thank you so much.